Welcome back. Earlier today, the PCE personal consumption expenditure was reported on a month over month basis, rose 0.2% versus a prior 0.1. The core PCE, which excludes food and energy, rose 0.2 versus a prior 0.3. PCE year over year slowed to 3.0. The prior number was 3.8. If you recall, the last CPI also declined to a 3.1. Core PCE year over year, 4.1 versus 4.6. So we see a decline across the board on a year over year basis. Here we can see the blue line is PCE year over year after peaking around the 7% level in 2022, is now really moving to the downside. Now, again, the Federal Reserve has a 2% inflation target, so it's believed that they will not stop raising interest rates until the inflation level, measured by CPI, Consumer Price Index, and PCE, Personal Consumption Expenditure, reaches that 2% level. Of course, as long as a labor market doesn't fall apart or the housing market doesn't fall apart, meaning as long as the economy looks resilient and we have inflation above 2%, it's believed that the Federal Reserve will continue to raise interest rates. Here's PCE month over month, and it really shows us to the decline that we've seen, especially excluding, or I should say, especially the standard PCE. Core PCE, which excludes food and energy, is less volatile. So the blue line going all the way up to the top, on a month over month basis, that includes food and energy. Food and energy are certainly the more volatile components of our economy. Now we see here CPI is in blue, the PCE is in white. The difference between the CPI and PCE, well, there's several different nuances. One is that the CPI more accurately reflects a level of inflation that we experience as consumers. PCE also includes government programs, so this when the spending of government programs goes up, the PCE will tend to go up. Now we see the gray histogram bars in the background show us basically the relationship between the two. It's a CPI divided by the PCE. So when the CPI goes up more than the PCE, meaning that when inflation for the average consumer goes up more than other levels of inflation, including government programs, then we see this histogram bar go up. And we're right near the top. So it really shows us that whatever inflation is still out there, and there still is quite a bit of inflation out there, it is affecting the average consumer. It's not just headline inflation because of additional government spending. You know, the inflation is real. Here's PCE in blue versus the S&P 500, a very strong correlation. We see both bottomed out in early 2020 and then hitting highs 21, 22. What's very interesting though is that the stock market has reversed course back to the upside while PCE, also CPI, but PCE in this case continues to decline. What's the disconnect? Where is there a disconnect? That inflation is still there while the stock market, well, inflation is subsiding while stocks rise. Well, there's a couple different ways we could look in this. We could look at this. We could say, well, maybe the price of goods and services is declining while we still expect corporate earnings to continue to rise, but eventually, one has to reverse course because historically there is, at least going back to 2016 and a lot further back, there is a very strong correlation. So one of these lines has to change course, either stocks to come down or inflation to start to rise. Here's PCE year over year versus core PCE. PCE is in blue. The red is core PCE. Again, the core excludes food and energy. So we can see the food and energy, when it's strong, it goes up a lot. When it's weak, it goes down a lot more. But generally speaking, of course, they follow a very similar path. Now, this chart in particular shows us from 1970 through 1988 because these are very historic periods of time in terms of inflation, and we peaked out, especially including energy prices in 1974, 1975, and again in the very early 1980s. Very interesting to see that we were registering 12% inflation levels at that point. Now, today, of course, we're talking about PCE, but thought it might be helpful also consider CPI, Consumer Price Index, same period of time, 1970 through 1988. Notice in particular, and this really breaks down CPI, the headline numbers in green, the purple is core CPI, excluding food and energy. The blue line is CPI food, and the red line is CPI energy. Take a look at the energy prices. We had over 40% energy CPI increase in 1980. And then, of course, we had that stock market crash in 1987. And prior to that, we had a real decline in energy prices along those lines. Very interesting to see how energy prices, at least during this period of time, really acted as a canary in the coal mines. Maybe it'll be the same, moving forward as well. We have seen a very big decline in energy prices lately. We spoke about during our last CPI report. So it'll be interesting to see if the pattern repeats itself. But for the headline number, we see inflation continues to decline. Maybe this is taking a little bit out of the wind from the sails of the Federal Reserve, giving them less reason to raise interest rates further. But we're still above the 2% target. To be continued. We hope this has been helpful. We look forward to seeing you back soon.